Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to a schedule of cash payments, which will be a bit more complex than a prior presentation we had on cash payments. Get ready. It's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that information into the blue area into our worksheet on the right-hand side. We have the expected sales items for January through June. That's going to be where our focus will be for estimated cash payments, although we're going to need the information for July in order to do so, which we'll see why shortly. So the monthly materials purchases is going to be a percent of sales for the next month. So we're going to have to take the percent of sales for the following month to figure out what our purchases will be for materials. So that's going to be our thought process for the materials. We'll have that kind of staggered kind of system that we will then need when we figure out our purchases, looking into either the prior month or a following month, which is going to be a standard kind of thing that will happen with these kind of estimates that will take place and we'll have to get used to. Percent paid in the month of purchase. So this is going to be for the accounts payable, and then percent paid in the following month, 60%. So we're going to pay for it when we make the purchases. In the month of purchase, 40% of the payment will be made, and in the following month, 60%, of course, those adding up then to the 100%. We also have labor costs per month, which we're going to estimate to be $4,500 actual cash payments going out in the month as the same month incurred. Fixed overhead, we're going to save is $4,000. Often that will be fixed in that, like the rent, it will be the same from month to month. Then we got some other items that sometimes on a cash flow basis will be periodic. They won't happen every month, such as interest payments made. We're going to say that we have interest payments that become due on March and June. So notice these are going to be cash outflows that happen on March and June. Remember, under an accrual basis method, we would be recording the interest expense as incurred, not necessarily when the payments were being made. Here, we're doing a cash flow statement. Therefore, we need to figure out when the cash payments, of course, are being made to make those payments. And then we have the commission, and we're going to say that the commissions are paid at 2.5% of sales. However, they're only paid out for June. So we're going to pick up the sales up from January to June, then figure that 2.5%, which actually gets paid in June at the end of the time period. So that's going to be one cash payment. Once again, if we were to think about this from an accrual standpoint, we would be allocating that commission to the periods in which earned, but cash flow, we're going to be allocating to the period in which paid, which will be simply June. Okay, so we're going to pick up the items for our estimated cash payments now. We're looking for the payments or outflows of cash. We're going to start off with sales because we'll need them in order to figure our cash payments, because some of our cash payments or our purchases, which will then feed into the cash payments, will be based on the sales projections. This will often be the case when we think about projections into the future. We will then need to think about the sales items first, the amount that we're going to need to produce and whatnot. And then we'll have to move on. So we'll have to do that ordering process typically when thinking about our budgeting process as a whole. So we're going to then take the 16,000 for January. February, we're going to say is the 18,000. March is going to be the 21,000. We have April picking up the 26,000. We've got May, which is going to be the 16. And then we have June, the end of our period, the 22,000. But then we're still going to pick up July, which is after the period that we're really considering, because we're going to need it in order to do some of the calculations necessary for the current period that we are covering. So then we're going to be considering the purchases of materials. Now we're going to be purchasing some of these materials, if not all of them, on account, meaning we may not be making the payment at the same point in time we make the purchasing them on account, them going through accounts payable, a liability account before we make the payment, which may happen in a future period. So that's why we're gonna add December here, because these are going to be the purchases that we're going to then need to calculate the payments on in the following month. So December is outside of the range we're focusing in on, which is January through June, but we still need it. So I'm going to include it in the table for the components necessary to do the calculations in the periods that we are looking into. So we then have the purchases. We're saying our monthly material purchases, percent of the sales for next month. So when we think about the purchases, we can figure out what our purchases are based on different kind of scenarios. What we think the purchases are going to be necessary for the current month. We might take a percentage of what we project the following month sales to be. So now we got this staggering process, but we're actually staggering the other way that we've seen before. In other words, in order to calculate December, I need to take a look at the sales that are happening in January, because I'm basing my purchasing on the estimate of the sales that are going to be taking place in January. So I'm going to pick up the January sales times the 35%. So January, so let's do that again. January sales up top, the 16, and then I got to hit the times button, times 35%. And we're going to keep on doing that all the way across. We got once again, this staggering kind of system. This, of course, is based on whatever the company policy is, which happens to be picking up 35% of the following time period. And those policies aren't standardized across all companies, because these are things that are not, standardized. These are things that could have best practices, but aren't written down in law as to how they will be done. So we're gonna, but they are best practices driven. So we should be able to have some idea and benchmark and be able to know what's happening with them. So we're gonna take the 18 times 35%, and then in February we're gonna be picking up the March sales and then multiplying that times the 35%. Let's do one more month, and then in March we're gonna be picking up April times the 35%. Now let's do our absolute reference and copying across using the autofill by double-clicking on this. When I copy across, I want the 26 to move on over to the 16, but I don't want the 35% to move over. Therefore, I'm going to go on this cell in B12. I'm going to select F4 on the keyboard, putting a $sign before the B and the 12. We only need $1 for a mixed reference, but absolute reference works fine. Then I'm going to put my cursor on the autofill and drag that all the way across. Now, I only really need to go to June, because that's the period that we are covering. July is outside the period. We're going to possibly need July. Why? Or we do need July. Why? To calculate the June number here. So that's why it's there. So once again, these two are outside. That's why they're red of our period, but they're necessary for the calculations to make our table as functional and easy as possible to build. Then we're gonna pick up the payments, calculating our payments. This is where the real focus is on the actual payments. These purchases we're gonna assume went through accounts payable, and now we're gonna figure out how much of them were paid and what period they were paid in. So we got the materials purchases. Now we could break this out into two separate sections, because it says here that a percent is paid in the month of purchase, and then we have a percent paid in the following month. So we could say, okay, if I went to the materials here, I could break this into two line items and say that we want to say that we can take the 6,300 purchases that were made in January times the 40%, and then have another line item saying the materials in the prior period times the 60%. Would be the amount of payment that were made for materials in the current time period, that adding up to the 5,880. We're going to this time combine them into one line item, just for materials, cash payments for materials. I'm going to combine those two calculations into one line item. We're going to say, all right, this equals to the current month purchases that we had. We made these purchases in the current month on account, but then we're going to pay them off in the current month 40%. And then I'm going to say plus, we have the purchases made in the prior month, in this case December, times the 60%. Now we don't need any absolute reference here, because it's going to multiply first. So we're going to multiply, and then add them up, just in terms of the order of operations. But you could put brackets around them if you so choose, if it's easier to see. Bracketing here, and then adding, and then we're going to bracket here. So let's do that again. I'll do this calculation a couple times just to practice this. In February, we're going to equal to the 7,350 February purchases that happened in this month. We're going to say that 40% of them were paid, plus the purchases happened in the prior month times 60% of the cash was paid for them in the following month. Let's do it again. We're in March. We're going to say we purchased 9,100 times, but we only paid for in the same month 40%, plus the 7,350 materials that we purchased in the prior month times 60% is what we paid for in the current month. Let's do it again. We're going to say this will be equal to the 5,600 April current month purchases times the amount that we paid in cash of that in the current month times the prior month purchases that we made times the amount of cash that we, oh, hold on a second, I have a times there. It's going to be this times this plus, and then we'll pick up the 9,100 purchases in the prior month that we're paying for in the current month of April. Let's do it again. We're going to say this will be equal to May's purchases that happened in the current month times the payment that we made for them in the current month, 40%, plus we're going to pick up April's purchases that were made times the amount of payment that we're going to be making in the current month for them, and that'll be the 60%. Let's do it one more time. This will be equal to the 8,400 times, that's the purchases we had in June, times the 40% that we're going to pay for in the same month, plus the prior month, 7,700 times the 60% that we're going to be paying for in the current month. So let's see, do these all line up? These look good. Now let's do this again with the autofill feature. So I'm actually going to delete these. You don't have to do this, but if you want to practice the autofill and absolute references, you can do so. I'm going to delete these items. I'm going to double click on the January one and see what can I do to make this work so I can copy it across. These two items I want to copy across when I copy from January to February. These two items, the percentages, I do not. So these two are in column B. So the two references to column B, I'm going to make absolute by putting my cursor in B15, selecting F4 on the keyboard, putting a $sign before the B and the 15, then putting my cursor on B17, selecting F4, putting a $sign before the B and the 17, and then enter. Now I should be able to autofill and have it, do this whole thing for us. Putting our cursor on the fill handle, dragging over to June. I'm not going to July because we only had that for the reference number. And then if I double click on June, it looks like it is doing what we want to do. So that looks good. And so we'll move on to the next one. So the next component should be much easier because the labor is just a given number. We just estimated the actual number for labor, and it's going to be fixed of the 4,500. So a couple ways you could do this. You could say this equals the 4,500. I could then make this an absolute reference, selecting F4, enter, and then copying it across so that I can simply use the autofill to copy that across. The other way we can do it, and this is useful sometimes more than not, sometimes it's better this way, sometimes not. I can undo that and say, instead of doing the absolute reference, I'll just go into the second cell and say this equals that January number. And then if I autofill this across, then I don't have to deal with absolute reference, and I can just autofill this across, and it'll just always be taking the cell before it. So sometimes that's a useful way to do it rather than doing the absolute reference. They end up both resulting in the fact that if we change the number over here, it will automatically change everything up top, which is basically what we're looking for in a forecasting spreadsheet. Then we're going to have the fixed cost, not Fox cost. And this is you could think about this like something like the rent, where once again I can pick up, it's going to be the same all the way across. This is often the case for many expenses where we're going to estimate basically the same amount all the way across, except for those for a cash flow that we don't pay evenly. We'll see that shortly. So I'm going to say F4 to put a $sign before the B and 20 to make it an absolute reference. Put our cursor back on it and then autofill that across. Autofilling that across. There's the 4,000. Then we have the interest. Now the interest, we can see down here, we said that we got a loan. We're imagining we have a loan on the books because we're paying interest, but we only pay, they become due on March and June. That's when we make our interest payments. We don't make them every month. We only make them on March and June. Now that doesn't mean that under an accrual method, we didn't incur the same interest expense. So under an accrual method on the income statement, rather, in other words, we would have to put an amount of interest expense in January, February, and March. But on a cash flow basis, we're actually paying the cash in March, even though we incurred the interest January, February, and March. So on a cash flow basis, we're going to just record when the cash payments are being made. So we're going to expect the interest payment to be made in March, which is going to be equal to the 3,100, and the payment to be made in June, which will be equal to the 3,100. Now again, remember that under an accrual basis on the income statement, you would expect to see probably the 3,100 divided by 3 as an expense January, February, and March, because we're using the purchasing power of the loan for those 3 months, even though we're not actually paying for it until the 3rd month. So it would be like us renting an office space that we only pay, once a year. We'd still have the rent expense every month because we used the office space each month, but we didn't pay it until the end of the year. So hopefully you can see kind of that difference in a cash flow projection and like a income statement accrual basis projection and recording of normal cash and accrual basis concepts. So then we have the sales commission, same kind of thing here. The sales commission is only going to be paid in June for all the sales that took place. So we're going to add the sales from January to June, multiply it times the commission, which is 2.5% that we're going to pay out to the salespeople. But it's all going to be paid in June, even though, obviously, once again, we would have incurred under an accrual basis method. We're actually incurring those expenses every month. So because the sales commission have earned their percentage each month that sales have happened, even though we're not paying them till June. So under a cash basis method, we're going to record that when the cash is paid under an accrual method. In other words, on the income statement for January, February, March, April, May, June, you will see an expense that will possibly be this amount divided by 6, showing it as it happens. So to do this, I'm going to say equals the sum of these 3 numbers, all the sales items from January to June. I'm going to close that up and then multiply that, say times, and then scroll down and we're going to pick up the 2.5% and enter. So we're paying the sales commission 2.5% of all the sales that happen for the 6-month time period, but we don't pay it till June. Again, cash flow basis versus an accrual basis, which we would take that number, divide it by 6, and allocate it evenly to the time period or that was incurred. Or we would allocate it based on the actual sales. 2.5% of the actual sales is what would probably happen on the income statement, on the actual income statement. Okay, so then we're going to say that we have the total payments. We're simply going to add these up then. I'm only going to be adding up for the period that we're covering, January through June. So this will equal the sum of. Now I'm going to add everything up, even the blank sales here. I'm not going to, in other words, I'm not going to start up here, even though there's blank cells down below. I'm going to add the whole thing up because when I copy it across, I want it to be standardized. So it's fine that it adds up 0 blank cell and blank cell. I want it to, when I copy it over to here, I want to make sure I'm picking up all the numbers. So I want to then use our autofill calculation, putting our cursor on the autofill handle, drag that on over to June, double click on June, make sure it's picking everything up. Notice it's picking those last 2 up. So that's what we want. We want this thing to be a box, a standard formula. So you don't want to try to, I'm not going to add up 3 numbers, and then 4 numbers, and then 3 numbers, and then 5 numbers. No, you're going to add up 5, 5, 5, 5. So you can make this whole thing conformity standard and use your copying and pasting formulas. So then we're going to select these items. I'm going to put an underline under the cell, even though it'll only show up over here. Home tab, font group, underline. So I'm going to put an underline there. And notice that this underline feature, that's kind of one of the drawbacks of using that kind of underline feature, because you'll only get an underline if there was something right above the cell. Some people I've worked with actually don't use a grid here. So the other way you could do this, I mean, say if you had these items down below, the same table down below, I'll just paste it down here. You might see some people that prefer, I'm just going to take off the blue area and take off the grid lines. And then let's make this just make it clear so we see those. So then some people prefer, instead of having this to be underlined, you will see them using the borders. See, there's no border here, it's just using Excel. So then you could use the borders to put an underline. And the benefit there is now you got a standard underline all the way across. And then you can use this underline and use the double underline there. And then you have a standard double underline all the way across. Some people like the look of that better. Of course, if I add a border to the whole thing, then it'll mess that up, right? If I add a border to everything, then then it kind of erases those double underlines, right? I can add the double underline. You kind of see that, but I'm not going to have an underline up top. So it just depends on who you're working with, if they like to use these underlines or if they like to use kind of the borders as the underlines. And if you work at a firm, you got to get used to some degree whatever the firm likes doing. Otherwise, they're gonna be upset with you, right? the accountants like to standardize things, so whatever's being done, you're gonna have to work with that. So in any case, we're gonna go to the Home tab, Font Group, and then double underline here, and there we have it.